Good morning and welcome to today's webcast, Revenue Recognition for Life Sciences is Changing. Before we begin, here are a few things to keep in mind. For best viewing, close out all other applications and turn up your speaker volume. You may adjust placement and window size using the controls in the top right corner of each window, or expand the slide view by dragging the lower right corner to resize. Ask questions today by entering your questions in the Q&A window below the slide view and clicking Submit. We'll do our best to answer all questions during the presentation or follow up via email. You can download a PDF copy of today's slides or the group CPE attendance sheet from the slide deck and handouts widget to the right of the slide view. If you experience technical difficulty during today's presentation, refresh your browser by hitting the F5 key. We'll ask polling questions throughout today's presentation. Per the National Association of State Boards of Accountancy webcast CPE standards, CPE credit will be awarded based on your participation in these polls. To respond to a poll, click the button next to your answer and click Submit. Today's session will offer you 1 CPE credit. To receive credit, you must meet the requirements as specified by the National Association of State Boards of Accountancy. You must attend at least 50 minutes of the session and respond to at least 75% of the polling questions. CPE credit can be awarded only to participants registered as themselves and is not available to participants who view the on-demand version. If you're attending this webcast in a group, you must complete our attendance sheet available in the slide deck and handouts widget to receive CPE credit. Please have all group members sign the sheet, and please remit only 1 sheet per group. We'll track your progress, and when you have earned your CPE credit, you can click the certificate icon in the CPE progress widget to download a PDF file to save to your computer. We'll email a copy of your CPE certificate in 2 weeks if you can't download it today. And as a reminder, today's presentation is not legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances. And with that, I'll turn the line over to Rich to get us started.
Thanks, Emily. Welcome to our RevRec for Life Science Companies webcast. Thank you all for joining. We hope you find this next hour helpful. My name is Rich Croghan. I'm the National Practice Leader of our Life Science and Medical Device Practice, and I will be your moderator today. We at Moss Adams host a number of webcasts across all industries and topics every year. We also issue regular alerts and insights throughout the year for issues that may be relevant to you and or your business. We hope you'll stay in touch with us. Moss Adams is a fully integrated professional services firm dedicated to growing, managing, and protecting prosperity. With over 2,600 professionals and staff across more than 20 locations in the market capitals of the West and beyond, we work with the world's most innovative, dynamic, and promising clients and markets. One of the top industries that we serve is the life science industry. Biotech, pharma, diagnostics, research organizations, digital health, and other similar companies. We serve more life science companies than any other public accounting firm other than the Big Four. Joining me today will be Findley Gillespie, a partner who works out of our Seattle office, but serves clients all over the West Coast. Findley has 20 years of experience and specializes in SOX consulting, internal controls, and internal audits. He heads up our healthcare internal audit practice and the life science med device practice for our Washington, Oregon region. Also joining us today is Arlene Chan. Arlene is based here in the Bay Area with me and has 25 years of public accounting experience. Arlene has a long history of working with life science and med device companies, both public and private. She's primarily an audit person, but she also provides a lot of consulting assistance to our clients, including helping our clients through RevRec issues. Today, we'll primarily be going through a few case studies that will illustrate how companies need to approach and address the new guidance under ASC Topic 606. To set the stage for the case studies, Findley will provide an overview of 606 and the 5-step process. Once that is done, Findley and Arlene will walk us through a detailed case study involving a biotech company involved in a licensing and development deal. In our second case study, Arlene will walk us through the analysis and considerations of a medical device company that has commercial sales. This will highlight some of the additional important provisions for commercial stage companies. After that, we will point out some common implementation issues, effective dates, and transitional guidance. Lastly, we'll go over an implementation strategy that we see many companies using. Before we go further, let's start with a polling question. As Emily mentioned, you need to respond to 3 of the 4 questions to get CPE. So this is a pretty easy one. How do you expect Topic 606 to impact your company? I expect it to have no impact, a significant impact, or minimal impact, but a lot of evaluation work will need to be done to determine that. So I'll give everyone here a little bit to respond. And hope everyone is finding the web easy to navigate. Just click on the round button, hit submit. I'll give everyone about 10 more seconds to submit it, just to make sure everyone gets the appropriate credit. And then we will be on our way. All right. So moving on. All right, the results. It looks like over half of the people expect that it will have a minimal impact, but a lot of evaluation work will need to be done to determine that. That's kind of what we expected. A lot of people are kind of struggling with how to analyze it. So we understand that. We too are digesting it and listening and talking to a lot of companies. Interesting, almost 30% expect it to have no impact. That's interesting. Maybe it's not today. I mean, research stage companies, or maybe it's a pretty simple revenue for companies. But good to know. Good to see. With that, I will turn the floor over to Findley, and who's going to tee up the further conversation and walk through ASC, provide a Topic 606 overview. Findley?
Great, thanks, Rich. So what we want to do now is provide just a short summary of kind of the 5-step process. We're not going to read definitions to you. We're not going to go over some of those things. We assume at this point most everyone's had an opportunity to hear kind of some generic presentations on 606, read some white papers, those sorts of things. But instead, just kind of cover those 5 steps and specifically ask some questions that would be relevant to you. And then what we'll do is we'll transition into 2 case studies. So just to begin with here, as we look through the 5-step process of just 606, it's really these 5 steps. It's 1, identifying the contract with the customer. 2, it's identifying the separate performance obligations. Again, that wording is a little different than we've seen in the past under current GAAP. 3 is determining the transaction price. 4, allocating that price to the separate performance obligations. And then 5, recognizing revenue as the entity satisfies each of those performance obligations. So again, we're going to walk through each of these 5 things in just a little bit more detail now, as it relates to your entity. So as we think about that, step 1 is identifying the contract. One of the things that's interesting for me is physically, under the new guidance, you could have two contracts, i.e. 2 pieces of paper, and those could become 1 contract. Those could be split into 2 contracts, right? And so it depends really kind of what those contracts look like and what that is. And so that's one thing we didn't call it here on this slide, but I want you to be aware of as you start thinking about those contracts. The other side of that is also understanding who is your customer and is it a contract with the customer. As you know, just the definition or the title of the topic or RevRec is revenue from contracts with customers. So let's talk about that for just a brief second. So let's say that you are a life sciences company, you've got a collaboration agreement. The question is that a contract with a customer? So in this slide, we've got the answer being yes if both of these conditions are met, right? So if you provide goods or services to the counterparty, which could include licenses of IP, the R&D you're doing as you develop the drugs, et cetera, and counterparty actually pays for those goods and services, which could include variable or contingent amounts, under milestone payments, et cetera. They're actually receiving that benefit. So again, thinking about some of these scenarios, the answer certainly could be yes. At the same time, the answer could be no, and we'll see that here in this next slide. So as we think about going through this 5-step process, what we want to share with you is that there's a number of decisions that need to be made across this, and certainly across all of your contracts, but just thinking about some of those key points. So in that first example, we said yes, it was. In this second example, the answer is no. So if the collaboration is really more like a partnership, then actually falls out of 606, is not actually covered by this at all. So let's look at that similar example using that same fact pattern. So if you and another party agree to co-promote a product and share any profit, and the other party pays you to cover some of the marketing expenses or some of those things, but they're not receiving the goods or the services, then this is actually outside of the scope of the new 606 RevRec guidance. So again, it's interesting to see how maybe some of these things can kind of get blurry. And so I think that's really important as we think about the contract. One is identifying the contract. Is there a contract? Is it one piece of paper that is one contract? Is it two pieces of paper that's one contract? Is it one piece of paper that's two contracts, right? Again, identifying the contract and then also saying, is this in scope for 606? And so obviously there's a whole number of things behind this, whether it's a distinct good or service, can you actually sell that, et cetera, et cetera. But again, be focused on the customer. Who is the customer and what are they receiving? That's one thing. And then separately, what is that contract? And so as we get into some of this, we're going to talk just a little bit more about each of these things. And then certainly when we get into the case studies, we'll dive much deeper into this. But again, something to be thinking about. So again, I said this is a 5-step process. The second step is identifying the performance obligations. And one of the things that's very interesting under this new guidance, and certainly for those of us who've been practicing in this a long time, and we've always come back to, you name your favorite EITF or VSOE or whatever term that you've got in mind, a lot of that can change here. And so this concept of performance obligation is one of those areas. And in this specific example, under phase 2, is identifying those performance obligations. You actually have the opportunity to unbundle some of those multi-element arrangements, which I know in the past has been very, very difficult. And the idea behind that, you can see it there in red, is if those things are distinct, if those are delivered and have standalone value to the customer, you can actually split those items up. So let's look at a couple examples there. So in this case, it says, if you've got a collaboration agreement, think back to that earlier example, and it's got an upfront, non-refundable license agreement, and then also has milestones for FDA approval, et cetera, et cetera, et cetera. These could be two performance obligations, right? One over licensing, right? So out-licensing that IP, and then the second one, the drug development, right? So that could be two, or alternatively, and it comes back to what that contract says, if the obligation in the contract, that performance obligation, was to actually deliver, if you were delivering a commercial drug, then that's only one performance obligation. So again, coming back to those contracts that we see in step 1 and in step 2, kind of how those things come together, I think that's really, really important to understand that. And again, what I'd like to say is, this is one of the first jointly developed accounting standards that we've had in the U.S. here with IFRS, and just how that's coming together. But as we look towards this, we're going to see more and more of this, whether it be here, leases, fair value, et cetera. A lot of these things are going to come down this path where, again, there's a lot more judgment allowed than we certainly under U.S. GAAP have had in the past. So again, it's really looking at these contracts. So it's interesting how that comes along. So when we get to the third step here of determining transaction price, this is where you start getting into the actual numbers behind all this, certainly. And so as part of this, I just want to highlight here a couple things. Is one of the things that's real interesting under 606, gives very specific advice on royalties. And so I just want you to be aware of that, because that's an important distinction for those on the call, given just your industry and what's going on. And specifically, in no instance can the transaction price include estimates of royalties of any of those IP until the certainty's been resolved? So again, it's kind of interesting how this all comes around, because one of the things under identifying the contract in step 1 is that it wants to have collectability as probable, right? So that's kind of the threshold that they have here. But then when you get to the determining the transaction price, it's understanding, is the transaction price going to include estimates of those royalties? And again, it's not until the uncertainty's been resolved. So again, there's some things there that are a little different, and certainly when we think about in the past, we've done it pro rata or not until X event had occurred, and certainly how that differs from the milestone payments. So again, there's a lot of examples there. The examples that we've called out on this page, again, taking that same example as last time, is an upfront, non-refundable license agreement that also includes a milestone for FDA approval, then a future royalty on sales. The milestone payment and the royalties represent variable consideration, and the milestone could or could not be included in the transaction price. So again, that's a change from how we've been thinking things in the past. So once you've determined the transaction price in step 3, then it actually comes back to allocating that transaction price in 4, and then recognizing the revenue in 5 as the performance obligations are met. So one of the interesting things here in step 4 is that you need to look at each performance obligation on the basis of a relative standalone selling price. But it doesn't mean that you've actually sold those things. And certainly you may not have carved out that separately. So again, coming back to those ideas of VSOE, it wouldn't need to have that around it. And I think that's going to be a struggle for all of us as we go through the accounting on this. But instead, is it actually the idea is could it be sold? Is there, could there be a standalone selling price for this? And again, as we think about this, if we've got one performance obligation, it's pretty easy. When we get into multiple performance obligations, it gets much more complex. And I'll go back to just 2 slides ago when we think about the instance where it depends on what really you're delivering under this collaboration agreement. Are you delivering A and B, i.e., is this a licensing agreement that also has development aspects to it? Or are you delivering a commercially FDA-approved commercial drug? So again, looking at those contract terms is critical in this. And as we think about those multiple performance obligations, it gets more and more complex. So again, after doing that, then you get to the, and really from my perspective, all the steps are critical, but step 3 and step 4 are where the hard math comes in of kind of really scrubbing and really evaluating these contracts. Certainly step 1 of understanding the contract and who the customer is, it's kind of that initial hurdle. Then you start getting to step 2, it gets a little harder, and then 3 and 4 becomes quite difficult. And certainly given, if you've got a lot of different contracts, they look very, very different. That could be a big challenge here in aggregating those things. So the 5th step is recognizing the revenue. So as part of that, when we think about that, is you've got the sell-through model, right? That a lot of you have used in the past. That is completely eliminated under 606. Okay, so that's one big change there, similar to going back to the royalty licensing component and understanding we're clear on what that is. But again, on this case, through 606, the sell-through method is eliminated. So again, what would happen is that revenue gets recognized once you transfer control of those goods or services to the distributor. And that's regardless of whether the arrangement is fixed or determinable. And again, coming back to those legacy words we have around RevRec. And so, again, that's one of those key things as we think about a lot of my clients that are going through this, and they've been using that sell-through basis for RevRec. So as we kind of close out this very first part of our deck, again, I want you to remember that really it's a 5-step process. Those 5 steps are well understood, I think, by the majority of people on this call. And then really the challenge is in each of these specific steps. So what we're going to do in just a few minutes is walk through 2 case studies and actually walk through the sticky parts, if you will, of these 5 steps as it relates to 2 specific examples, one life sciences and one med device example. But before we do that, I'm going to turn it over to Rich to ask another polling question. Rich?
Thanks, Findley. All right, so which of the 5 steps that Findley just elaborated on do you expect to be the most challenging in evaluating Topic 606? Identifying the customer, identifying the separate performance obligations, determining the transaction price, allocating the transaction price to the separate performance obligations, or recognizing revenue when or as the entity satisfies the performance obligation. So there's no wrong answer. We're just looking for information about where people may be struggling. Depending upon your facts, any one of these can be challenging. So, all right, I'm going to give everyone about 10 more seconds to respond, and then we'll close it out. All right, and we'll close it. All right, I think the overwhelming one was allocating the transaction price to the separate performance obligations in the contract.
Well, Rich, that's great, because that's where I think the sticky part is in doing this. Is I think through the 5 steps, certainly all of them have kind of hang-ups and twists and turns, but I think that's just what I'd share. So that's great to hear. Yep. So what we want to do now is jump right into our first case study. And so let me set just a little bit of the background before we jump in and take kind of step by step. And again, mirroring kind of the complexity we just saw on that polling slide, is we're going to spend more time on kind of steps 3, 4, 5. But let's set the background. So let's read this together. I know it's kind of mundane to read this to you, but I want to make sure that we have the background set, and then we'll dive into the specifics. All right. So let's assume that a bio company out-licenses a drug compound under development to a global pharmaceutical company, right? So you're out-licensing it to Big Pharma. Got it. Secondly is that you agree to perform development activities with the goal of commercializing this new drug compound. So what you'll receive under this collaboration agreement is you'll receive an upfront payment of $10 million, and you're entitled to milestone payments or a milestone payment of $50 million upon each enrollment upon enrollment of 100 patients in a phase 3 trial. Okay. And then ultimately regulatory approval. So as part of this is once that goes and then becomes a commercial drug, you go through the FDA process and get approval there, then you'll get royalties on it. So again, a pretty standard contract when we think about most of you and most of our clients. All right, so let's look at step 1. The first question is this a contract with a customer? So as part of that, the question is, okay, hey, is this, the large pharma company actually a customer? So is it going to receive goods and services in exchange for the consideration? Well, it depends, right? So what are they going to actually get from that? Are they buying the IP? Are they getting an ex-US or what? How do you carve that out geographically? What does that actually look like? Or is it really more of a partner in the collaboration agreement in which you're both participating and you ultimately are developing that drug? So again, part of that's coming back to the example that I shared earlier of really understanding is this a contract with a customer? And then what is that contract? And as we go through that, there's going to be some challenges as we think about what that looks like. So again, that's the first thing is understanding what that looks like. So we're going to walk through this all 5 steps and kind of present those challenges. We'll also present some of the old gap and some of the new gap, just to give us all kind of a common frame of reference. So again, this is one of those examples where it could go either way, and we'd have to dive back into the contract. One of the important things to know, important things to look at is how much or how many of these contracts do you have? How onerous is it to really do this evaluation on kind of a one-by-one basis? And for some clients, certainly if you're earlier in your phase 1 trial and you're pretty earlier, it might be easier. And others might be very complex, also depending on what your pipeline looks like, how many drug candidates you have. So certainly let's dive in a little bit deeper. So that's step 1. Step 2, again, identifying the separate performance obligations, right? So here's the first question. Would the license to that new drug compound and the research represent 2 distinct, and again, that comes back from the literature, distinct performance obligations? And so that's one of those examples where it could and it couldn't, right? So again, as we think about what that looks like, you have to be really clear of what the intent is and then how the contract's worded. And when you're thinking about, and this is the operational side, and this is where I spend a lot of my time working with clients, is as you think about entering into these new agreements, be thinking about this as you enter into those agreements. What are we really signing up for under this agreement? What is our role? What is their role? And how would it be reflected in 606, in a 606 analysis, right? So is it one performance obligation? Is it multiple performance obligations, right? Be thinking about that. You know, one of the things, and that's captured in that second bullet, I think it says it very, very well, is understanding really what is the promises that you've made. What is that obligation? What is that commitment that you've made, certainly to your partner in this case, or that large pharma, you know, whoever it may be. So understanding what does that really look like. But again, coming back to the key criteria from the guidance itself, says a performance obligation is a promise in a contract to transfer a good or service. So again, thinking about that. The last bullet point there, right, it's, you know, one of the last thing is, have you really committed to transfer kind of the combined item? This is what we talked about earlier, a approved drug compound, or is it really two things? And we've already said that a couple times, but I think it's important to highlight that. And so, you know, really one of those things as we think about that concept of being distinct, it's really combined, and it really comes down to two things. One is, does this benefit the customer on its own? Is it capable of being distinct? And then two, is it separately identifiable from other promises? You know, distinct within the context of the contract. So again, as we think about these things, it comes down to those things that really leveraging off the word distinct there. And it's only distinct if both of those criteria met, right? So would it benefit the customer, and is it separately identifiable from those other promises? And sometimes that's the sticky part, is how can it be stripped out, right? So if one is an input to produce something out, kind of a combined output, how do you strip those things apart? How do you break that apart? What if it doesn't really modify or change another good or service in the contract? You know, is it highly dependent or interrelated with other things going on? Again, those all speak to that concept of are they distinct? So again, it's important to be thinking through those things. And what we're going to do is we're going to walk through this in more detail now. And certainly from that polling question, I think the respondents said it very well, is that really kind of step 3, 4, and 5, and likely 4 is one of the most challenging ones. So those are really the most challenging steps. So as we think about that, and as we get into these future steps, we're going to be spending a lot of time talking about that. So we've got this one now that we'll go through, walk through this case study, and then we'll get to a shorter case study on medical devices. So what I'm going to do now is turn it over to Arlene. Arlene, you want to take us away with step 3?
Sure. Thank you, Findley. So let's continue with step 3, which is to determine the transaction price. Our first task is to look at the payments and determine what are the fixed versus variable payments. The literature tells us that there are 2 ways of estimating variable consideration. The 2 ways are, the first one is expected value, which is the sum of probability-weighted amounts in a range of probable amounts. And the second way is to determine the most likely amount, which is the single most likely outcome within a range of probable outcomes. So once you look at what are your variable payments and what is your variable consideration, you would then apply a constraint in arriving at the transaction price for that variable item. In other words, once you think, okay, I think I have a probable amount relating to this variable component, do I really have a probability that this is going to be realized, that this is going to be achieved? This is where the judgment and estimate comes in, because the requirement is that the entity has experience with similar contracts and is able to estimate the cumulative amount of revenue, which would be based on experience. So the key here, and I can't underline this enough, is that revenue should be probable of being recognized. In other words, when the uncertainty is resolved, or when there is a subsequent change in the estimate, there would not be any significant reversal of revenue. And this is really key. So returning to our case study, we're looking at the items that we had mentioned in the case study, There is a $10 million upfront payment, and that would be fixed. There are two $50 million milestone payments that would need to be assessed to see if any of those amounts should be included in the transaction price. Now, part of the judgment is, and it's very facts and circumstances based, if the company is already in the middle of enrollment for the trial, then there may be a good support for the enrollment milestone to be achievable or probable of being achieved. But the regulatory approval milestone contains enough risk that it should be excluded. Similarly, when we look at the royalties, as Findley had already mentioned, the literature is clear that royalties should not be included unless the uncertainty is resolved. So for our purposes, for this case study, we would exclude that. So now we look at the license. Is the license functional or symbolic? If the R&D services and the license are not interdependent, then we would say that it has a distinct performance obligation. One factor to consider is whether there are downstream royalties that are separate from the company needing to manufacture, the biotech company needing to manufacture the product downstream. That may suggest that the IP is functional. If the license is functional, then when we get to step 5 for revenue recognition, this portion may be recognized when the transfer of the license is completed to the customer. Now, if the license is not functional but symbolic, then it should be recognized over time together with the R&D services. So some other complexities include non-cash consideration or if there is a significant financing component. We're not covering these today, but those involve and warrant further analysis in terms of arriving at what your total transaction price is. So once you have an idea of what your total transaction price is, we now move on to step 4 to allocate the transaction price to each of the separate performance obligations in the contract. Now, how do we go about this? The devil is in the details. The new RevRec guidelines require the use of a relative standalone selling price method to allocate the transaction price to each separate performance obligation. What are the methods available? This new literature gets rid of the concepts of VSOE, TPE, and BESP. The primary method is the observable price sold in a separate transactions or in multiple separate transactions. The company should maximize the use of observable inputs, and the price used should be applied consistently across goods or services with similar characteristics. So in our example, we have a license. Has the license been sold in a similar situation in the past with other similar customers? R&D services. Has the company also performed R&D services for other customers in the past, or is there a general consensus in the market for what R&D services would cost? Now, if standalone transaction prices do not exist, there are some estimation methods available. And I'm going to go over these really quickly. But again, these require significant judgment and estimates. And I think as an auditor, every time I hear judgment and estimates, I would think that that would require documentation and support for how the company arrived at their conclusion. So the 3 estimation methods available if standalone transaction prices do not exist, or if the company has historically not sold these goods or services before, these are 3 methods that you can apply. The first one is an adjusted market assessment approach. To me, that could be akin to an FTE rate for R&D services, and you would adjust it based on your facts and circumstances. The second method is the expected cost plus margin. In other words, cost plus. Lastly, it's the residual method. Now, keep in mind this is not the residual method that we are familiar with in the software RevRec world. This residual method is basically to estimate a standalone selling price. And it may only be used, there are some restrictions here, it may only be used if the company has either sold the product with a large variety of prices across a broad range of customers, or if there is not yet established a price for the goods or services, and these goods or services have never been sold before. Now keep in mind that this residual approach is not the total transaction price less the known standalone selling prices for the other performance obligations. This is just part of the formula for figuring out the standalone selling price for this one item, and you would still need to do a relative allocation afterwards. Keep in mind also that discounts in variable amounts are allocated to specific performance obligations as long as the criteria for probability are met. So once you've determined that the individual standalone selling prices of each performance obligation exist, you'd add those up and you would then do your allocation to determine the relative percentage for each component. So for purposes of our case study, let's say we've determined that it should be 20% for the functional license and 80% for the R&D services, which is estimated to be performed over a 4-year period. Okay. Now we come to step 5. The company should recognize revenue when a performance obligation is satisfied. So if we have a functional license, then based on our initial assessment of 10 million transaction price with a 20% relative allocation to the license, then upon delivery of the license to the global pharma company, you would recognize 2 million. And the revenue for the R&D services would be recognized over time as the company delivers those services. But if the license is symbolic, then you would not have the 2 million and you would recognize the license and the R&D services over the duration of the 4-year period. Now here's an interesting question. What happens if the milestone for the enrollment of the 100th patient in the clinical trial that was not initially included in the estimated transaction price is now deemed to be probable of achievement? So in other words, you have a change in estimate. We would now need to revisit step 3 to determine a revised transaction price, because now we would have 60 million instead of the initial 10 million. The next step is asking yourself, have the relative allocation percentages changed? And the answer is no in this situation. So based on the revised estimate, you will have revenue associated with the license to be 12 million instead of 2. And you would recognize the difference as an adjustment to reflect the true-up of your estimate. And you would do a similar true-up for the R&D services revenue. The key here, key takeaway, is that estimates would need to be adjusted each reporting period, and to the extent that such estimates change, you will have true-ups to revenue.
All right, Arlene. Arlene, let me jump in here before we get into
Sure.
case study 2. So a question came in that I wanted to run by you because it seemed timely. Someone asked, what if there's a modification to the contract? You know, there's a change in the pricing or a change in the deliverable after the initial contract. How would you address that?
So that's a great question. Anytime that there's a change, a legal change to the contract, modification, you would need to go back and assess. Typically, you would start at, depending on what the modification relates to, you would start at step 2 to see if you have a difference, a change in the performance obligations, and you would go through the rest of the steps in order to determine what is pertinent for the remainder of the contract period in terms of your price, your delivery, and your performance obligations. And you may need to revise your allocation percentages as a result of this exercise. And you may have a change in, you will have to true up your revenue if your percentage or allocation or recognition periods change as a result of your contract modification.
All right, great, thanks.
So we will now go into a detailed case study for medical devices. There are a fair number of folks in the audience who are in medical devices, and therefore hopefully this will be helpful. So let's go over the case study, the facts for the case study. So a medical device company receives regulatory clearance to begin selling a new device. So following this approval, the company readies its plant to produce large quantities of the device. Additionally, at the same time, the company's sales lead contracts with the world's leading distributor to sell the devices. And as part of this, earns a sizable commission. Now, the distributor places an order for 100,000 units, and of which 60,000 of the completed units is requested to be shipped, and the remainder 40,000 units should be stored in a warehouse. And the warehouse belongs to the medical device company. And the parties agree to this. It's because it's cheaper to manufacture in bulk, and there's no impact to the products because of long shelf life. So let's think about step one. Who is our contract with? Since 606 got rid of the sell-through method, it is now only sell-to. In our situation, the contract has to be with the distributor as the customer. So then we would think about our performance obligations. Okay? Under the facts of this case study, we may actually have more than a single performance obligation, which on a prima facie basis, we would think, oh yeah, I'm selling units. My performance obligation is to deliver units of my medical device to the distributor. Well, in this case, we actually have to think about whether the storage commitment is a deliverable. So in this case, under topic 606, you would have two performance obligations in which the second, the bill and hold arrangement, creates a performance obligation of storage. So the revenue that would be associated with delivering the units, the initial 60,000, would be what you would normally think of your sales cycle. And then you would need to identify a performance obligation relating to the commitment to store. And that revenue would be over the time period that you were requested to make the storage available. And it's almost as though the customer is renting a portion of your warehouse, even though they don't explicitly say it that way in the contract. Now, an additional fact pattern here, assume that the company plans to protect its customer from any risk of damage while the 60,000 units are in transit. And even though legally the risk has been transferred to the customer at shipping point per terms of the contract. Now, the current GAAP says you may not recognize revenue until the products arrive at the final customer location. Well, 606 will say that you may also have an additional performance obligation in this situation because you may have provided an implicit performance obligation by having that insurance. So these additional performance obligations will need to be factored in for step 3 when determining the total transaction price, and also for step 4 for allocating to each performance obligation. All right, so For step 3, when you're determining the transaction price, don't forget to factor in the variable items that may affect your ultimate selling price of the device to the distributor. Common items may be cash rebates, discount, tiered discounts or commissions, and refunds, and other. Okay? Keep in mind that revenue is required to be the probable amount without significant adjustment when the uncertainty resolves. So in this situation, the probability weighted method or most likely outcome would come into play when you're looking at determining what your total transaction price is, which is a factor of what your ultimate selling price is going to be on a per unit basis for each device. So again, as mentioned before, estimates would need to be updated for each reporting period and revenue accordingly trued up. So under step 4, we would have some additional considerations. Commissions is one area where there's currently diversity in practice, whether commissions are expensed as incurred or there may be others that defer and amortize. 606 requires that for contracts with durations for over a year, that the commissions must be deferred and amortized on a systematic basis. That is consistent with a pattern of the associated revenue. So for companies who don't currently defer and amortize in this manner, you would need to set up a process for capturing this information. And similarly, last but not least for this area, plant configuration costs should be evaluated, and you would also capitalize and amortize these costs if they were necessary to meet the obligations of the contract, and if these costs were not already specifically addressed by other accounting literature. And now, I'm handing the mic back to Findley to highlight to move on to the next portion.
Great, thanks, Arlene. So one of the things that we've seen with a number of clients is just kind of the typical implementation issues. So let me just pause here for just a second and speak to a few of those. One is applying really kind of a portfolio approach to contracts or group of contracts. Again, each one is distinct and there's so much judgment involved. And so a part of that is also understanding those performance obligations. We spent a lot of time talking about that. You know, as we think about this multi-element allocations, all of that is a lot harder, right? So thinking about just the judgmental aspect, and I know certainly within U.S. accounting, we just love the rules and we like to be able to tie that back, et cetera, et cetera. So again, as part of that, it's just thinking about what those things look like. And then the last thing is just the disclosures required. And this is one I'll just pause on briefly, is basically as part of this is the SEC is asked already, so if you're a public filer, the SEC is asked already if or they've asked you to disclose what your plan is, what you're doing, what you plan to do. So again, be thinking about that. Look at the other peer companies in terms of what their disclosures are. So those are some of just the common issues. I'll turn it over to Rich to speak just a little bit about some of the tax-related impacts. Rich?
Thanks, Finley. We briefly want to remind companies that as they're working through the accounting considerations to not forget about the tax implications. Revenue recognition will have tax impacts. It'll have federal impacts, potential international impacts, some state and local impacts. As it appears, a lot of revenue may be accelerated. Think through how that might affect your company in the year of adoption, and also that prior period adjustment going through retained earnings. How's that going to impact your tax position? Is it going to throw you into a taxable situation? Do you have sufficient losses or credits? How's it going to impact your tax provision? Should you relook at what your tax accounting method is at this point? And just from a filing perspective, there are likely to be specific accounting method changes requested with the IRS. So just wanted to throw that out there. We talk a lot about the GAAP treatment, but there are going to be some tax impacts that also go along with this. Finley, back to you.
Thanks, Rich. So as we think about just as we get to the practical side of how do we do all this, right? So one is just the effective dates. So if you're a public company, you've got to start that for calendar companies, beginning with Q1 of next year, Q1 of 18. So again, that's very, very quickly, or it's coming up very, very quickly. Obviously, both public and private companies can early adopt. If you're a private company, you get an additional year. So again, be thinking about that. In terms of the two common methods for adoption is you really get two different ones. One of them is the full retrospective, and that's where you would actually take and you would actually restate effectively what your financials look like, and that could expand back 2 or 3 years. So again, think about the work that you're doing right now, looking at what that is. So again, for public companies, we have to have comparative financials and they go back some period of time, is understanding what that looks like. So again, you would effectively restate that. The other one is a cumulative catch or modified retrospective, where basically you do a cumulative effect of what that looks like at implementation and then push the delta straight through to equity. Now, one of the things that a lot of our clients have been looking at is what does that look like, certainly as a public company, is those revenues, there may be an instance where some of those revenues never get reported publicly. So again, that's a critical distinction. And when I think about a lot of companies making that selection on how they want to transition, whether it be full retrospective or modified, i.e. cumulative catch-up, is they're concerned about are they going to ever get the opportunity to report some of those revenues. So again, the way you're going to recognize those is going to be revenue, or is going to be different, and then how you would actually show that transition could be different, and then what those disclosures are. So again, there's a lot of those impacts and a lot of things that need to be considered there. So as we really get to the end of this, we want to finish up with with another polling question. Rich?
Yeah, thanks, Findley. All right, this is the third polling question. Remember to respond so you get CPE credit. Under the modified retrospective transition, some amount of revenues may never be disclosed and instead put through as a cumulative effect to equity. Given the importance of revenue reporting to your shareholders, how important is revenue disclosure? Shareholders will understand. Shareholders are focused on other metrics, so this is not a concern. This is critical to our shareholders, so we will do a full retrospective transition. Or lastly, we don't expect Topic 606 to significantly impact us, so this doesn't apply. So while I wait for everyone to submit their answer, I also want to remind people to, if they have any questions, to use the Q&A button. We have a handful of questions coming in. We'll try to get to them here before the end of the hour. And to the extent that we don't get through all the questions, we'll send out a follow-up to all the attendees and registrants. So feel free to ask any questions that you would like. All right. So moving forward, all right, so half the people don't expect 606 to significantly impact us. Well, that makes it a little easier. The other, for the 50% who think that it will impact it, they're kind of split between whether the shareholders will understand or not otherwise be concerned with it. All right. So wrapping up here, so we've talked, we've talked about did a quick overview. We've done a few case studies to highlight the considerations. Now, what do companies need to do? So generally, what we see are companies thinking about the strategy to address these issues and using a three-phased approach. Generally starting with an initial assessment. This might be part of your initial assessment. Most of our private companies are in this phase. Some are still getting to this phase. There's a couple steps involved within phase one, familiarizing yourself with the standard. Hopefully this is helpful for that. Maybe you're already moving into a high-level assessment or some sort of documentation. But most private companies are here. Some private companies have moved into phase two for planning. Maybe those that are further along in their development or life cycle planning, and that's really coming up with the detailed plan and the controls and the systems to track and document the information. Phase 3 implementation. Most of our public companies are here, documenting, performing analysis, and analyzing the data, and then completing the memos and disclosures. Most are here. Some are still struggling here. Fully understand that. So with that, you can, we put this out there. That's what we see a lot of our clients using, this type of approach. If you're still in it, this might be helpful to jumpstart or target your approach. Now, with that, we're moving to the last polling question. Again, answer this so that you get CPE. Where's your organization in its 606 implementation strategy? Risk assessment, moving into, or is it in the planning phase, or have you gone beyond that and starting to implement? So again, we'll give everyone a few seconds to answer here. As I mentioned, everyone needs to complete 3 out of the 4 polling questions to get their CPE credit. All right, 10 more seconds. And moving forward. All right, that's what we kind of assumed. We figured that we were looking at who was joining, and that a lot of people are in the private companies, and most are still assessing the risk. So 2/3. So that's great. With that, I'm moving on. Emily, you want to take over and then send it back to me, and we'll ask a couple of the questions that came through.
Sure, thank you. And thank you, Findley and Arlene, for a great presentation today. Just before we get into the Q&A, I want to remind everyone that if you attended today's presentation in a group and would like to receive CPE credit, you must complete the group attendance sheet found in the slide deck and handouts icon to the right of the slide view. And if you've participated as an individual and met all certification requirements, your certificate is available to download now in the CPE progress window to the right of the slide view. And after the Q&A, I'll leave the console open for a few minutes to give you time to download your CPE certificate. If you are unable to download it now, we'll be sending a copy within the next 2 weeks. And Rich, I'll turn it back to you for Q&A.
Okay, so on the slide here is just some resources if you want some additional information. With that, so some of the questions that came in, Findley, here's one that I think you might be able to help out, or Arlene, feel free to jump into. What type of systems do you see helping with assessing and documenting the accounting for revenue recognition?
Yeah, so what's interesting for a lot of our life sciences clients is this is so manual in terms of just contracts. Now, I know there's some tools out there that can kind of do some kind of automated extracts and pull dates. But as part of this is again, because so much of it's driven off of contracts, and there tends to be a lot fewer contracts than, say, like in a high-tech environment, one of the things is just making sure that you've got that information pulled together. And the biggest piece is just aggregating that information. And we talked earlier about bundling. It's important that you don't misbundle things, if you will, between contracts, because the contracts tend to be so unique. And so as part of this is just looking, as you think about systems, leveraging whatever you have in terms of some sort of contract tracking device, whether a tool, spreadsheet, et cetera. Also looking through and really combing through the deferred revenue schedules you have, et cetera. And again, that has to go back years. Certainly if you're a public company, you've got comparative statements, and you're going to do a full retrospective, again, thinking about that. So again, it's important to think about those things. There's not a beautiful kind of one-size-fits-all solution, because so much of it's around the contract. But again, taking that 5-step process and driving it into what you do is critical.
All right. Finley, here's another question that kind of came through, and just a quick response. I don't know if it is a quick response. Do you expect most private companies to early adopt?
I wouldn't at this point. I think that the instances where there's a need for early adoption, we've seen that already in the public markets, is where they've got something coming up, maybe a pending acquisition, maybe they've got something else going on, maybe they got some kind of a deal flow, they've got whatever it is, where that would be advantageous to early adopt. And so we've seen very few. There are examples certainly, on the public company side that they have early adopted, but it's pretty few. And I would expect private companies, frankly, and we saw that last polling question, Mark, this is a good question, is we saw the last polling question, a lot of people are still in the risk assessment, kind of figuring out what this looks like. And because of that, I would imagine that most are going to take advantage of that time that they have.
All right. Thanks, Findley. So with that, it's noon, so our time is up. Thank you all for joining. With that, Emily, back to you for the survey information.
All right. Thank you, Rich. And thank you, everyone, for your time today. Here's a link to an online survey where you can provide feedback for today's presentation. Please take a moment to complete this survey, as your feedback is very important to us. And thank you again for joining us, and we hope you'll join us again next time.